Hello friends, once again I am back with the subject of export finance, and in the first part of this discussion, the discussion on export finance, we covered what is export finance, who can finance, and what are the different types of export finance, right? And we learned that there are basically two different types of export finance. One is pre-shipment finance, another is post-shipment finance. Export finance assistance is extended at various stages of exports, right? And all the loans or advances which are granted by financial institutions to exporters for financing the purchase, processing, manufacturing, or packing of goods before the shipment are known as pre-shipment credit or pre-shipment finance. And the loans or advances which are granted by financial institutions to exporters from the date of extending credit after shipment of goods is done, and in fact after shipment of goods to the date of realization of export proceeds, are known as post shipment credit, right? Just to have a quick recap, there are four different types of pre-shipment finance. First is packing credit, we already covered. Second is advance against incentives, we already covered this one also. Pre-shipment credit in foreign currency, that we are going to discuss today, and in fact advance against checks or drafts, the last one. Okay, so coming to the pre-shipment credit in foreign currency or PCFC. So basically foreign currency credit in foreign currency helps you in purchasing imported inputs of the goods which is required for manufacturing or giving the final shape of finished goods. Okay, so it helps in covering both the domestic and imported inputs of the goods exported from India, right? And it is available in any of the convertible currencies like USD, pound, sterling, euro, yen, etc. It is self liquidating in nature, means repayment will happen out of export proceeds, right? How about the period of credit in case of PCFC? So the PCFC or pre-shipment credit in foreign currency will be available for a maximum period of 360 days. And any extension of the credit will be subject to the same terms and conditions as applicable for extension of rupee packing credit. So in case if there is any requirement of extension of credit period of PCFC, the terms and conditions which hold good for rupee packing credit will also hold good for PCFC. Okay, this is very important. The rate of interest on pre-shipment credit in foreign currency is linked to LIBOR, or we call it as London Interbank Offered Rate. It's also known as Euro LIBOR. So what is LIBOR? LIBOR is basically, as I told you, it stands. This word stands for London Interbank Offered Rate, and it's a benchmark rate that some of the world's leading banks charge each other for short-term loans. And what is the relationship between interest rate of PCFC and LIBOR? So it's foreign currency credit at LIBOR plus 100 basis point. We already learned what is basis point. One basis point is equivalent to 0.01%. If you could recall the relationship of prime lending rate and basis point in case of packing credit, that was local currency at PLR minus 250 basis point. Here it's LIBOR plus 100 basis point in case of PCFC, right? And one more guideline, the final cost of exporter must not exceed 0.75% over 6 months LIBOR, tax excluded. And any exchange rate risk associated in this transaction is a botheration of exporter. So exporter has to take care of any exchange rate risk, right? And after the shipment, bills will be eligible for discounting or rediscounting or for post-shipment credit in foreign currency, right? So these points are very important. Moving ahead, the exporters can avail this finance, I mean the pre-shipment credit in foreign currency, under the following three options. Okay, what is the first option? The first option is avail pre-shipment credit in rupees, okay, and then post-shipment credit either in rupees, or you go for discounting or rediscounting of export bills under EBR scheme. What is EBR scheme? If you want to have very detailed knowledge about EBR, I suggest you to visit different websites where you can find this information in detail. But to have superficial knowledge about it, I can tell you EBR is Export Bills Abroad Scheme. Okay, you can go for discounting or rediscounting the pre-shipment credit under this scheme, but you need to be careful because EBR will cover export bills with usance period up to 180 days from the date of shipment. And in case the exporter or the borrower is eligible to draw usance bills for the periods of more than 180 days, as per RBI Foreign Exchange Department guidelines, post-shipment credit under EBR may be provided for more than 180 days. Okay, so this is the first option. You avail pre-shipment credit in rupees and then go for post-shipment credit either in rupees, or go for discounting or rediscounting of export bills under EBR scheme. And then what is the second option? The second option is you go for pre-shipment credit in foreign currency, okay, and then discounting or rediscounting of export proceed bills under EBR scheme. So here you are availing pre-shipment credit in rupees, here you are availing pre-shipment credit in foreign currency, right? And the third and the last option is avail pre-shipment credit in rupees, that is Indian rupees, and then convert the drawals into PCFC at the discretion of the bank. So in the beginning you are taking pre-shipment credit in rupees, and then you are converting this into pre-shipment credit in foreign currency, but it all depends at the discretion of the bank, right? So we'll move forward. Let me change it to laser pointer. Okay, the next point is pre-shipment credit in foreign currency is available both to the supplier units of EPZ or EOU and the receiver units of EPZ or EOU. What is EPZ? We will try to cover this terminology sometime later in our discussion, but for the time being, and I hope you all of you must be knowing, or at least most of you must be knowing, what is EPZ and EOU. EPZ stands for Export Processing Zone and EOU stands for Export Oriented Units. Similarly, SEZ stands for Special Economic Zones. So PCFC is available both to the supplier units of EPZ or EOU and the receiver units of EPZ or EOU. Okay, and the PCFC for supplier EOU or EPZ or SEZ, in fact SEZ stands for Special Economic Zone. So the PCFC for supplier EOU or EPZ or SEZ unit will be for supply of raw materials. Okay, because this supplier will be supplying raw materials to the firms, right? And the PCFC extended to the supplier EOU or EPZ or SEZ unit will have to be liquidated by receipt of foreign exchange from the receiver unit. Okay, one thing bank has to take care that there should not be double financing for the same transaction. Means, what does it mean? In fact, I have noted down. Yes, this point is already there. It means for the same transaction, both supplier and receiver unit should not get this pre-shipment credit in foreign currency, right? So there should not be any duplication or repetition of PCFC for the same transaction. And it's also available to Asian clearing countries. Okay, exports to Asian Clearing Union countries. ACU stands for Asian Clearing Union. Asian Clearing Union is basically uh, a union of central banks of few countries, and those countries are Bangladesh, Bhutan, Iran, India. We are a member of ACU, Maldives, Nepal, Pakistan, Sri Lanka, and Myanmar. And this ACU has their headquarter in Tehran, that is Iran. Okay, and basically the primary objective behind establishing ACU was to secure a regional cooperation regarding the settlement of eligible monetary transactions among the members of this union. Once again I repeat, India is a member of ACU. This is the list of members as in 2016, so this is the latest list. Other members are Bangladesh, Bhutan, Pakistan, Nepal, Maldives, Iran, Sri Lanka, and Myanmar. Right? And this PCFC is extended only on the basis of confirmed or firm export orders or confirmed LCs. Okay. Unlike packing credit, which we have studied in the last discussion, in PCFC there is no running account facility. Okay. Now the fourth and the last one is advance against checks or drafts. In case the exporters receive direct payments from abroad by means of checks or drafts, etc., means there is no LC, the bank may grant export credit at concessional rate. So even if you are receiving this payment against your export sales directly by means of checks or drafts, bank still give you export credit at concessional rate, but bank will take utmost care that your track record is very good. So exporters should have very good track record. And advance is given till the time of realization of the proceeds of the checks or drafts, etc. This is self-explanatory. And bank ensure themselves that the proceeds are against the said export order. Means if you are availing this credit facility in this kind of transaction where you will receive your export proceeds by check or draft directly to your account, the bank must ensure that the financing or the credit which has been given to you is exactly against that particular export order only, right? Then now coming to the post shipment finance. First of all, let's see what is post shipment finance. So any loan or advance granted or any other credit provided by a bank to an exporter of goods from India from the date of extending the credit after shipment of goods. Here this is very important because it's post shipment, right? It's post shipment, so it's only after the shipment of goods is done. So I read it once again. Any loan or advance granted or any other credit provided by a bank to an exporter of goods from India from the date of extending the credit after shipment of credits to the date of realization of export proceeds. So basically post shipment finance is a kind of loan provided by a financial institution to an exporter or seller against a shipment that has already been executed, right? And while granting this post shipment finance, banks are governed by the guidelines which have been issued by the RBI, the rules of the FEDI, that is Foreign Exchange Dealers Association of India, the trade control and exchange control regulations, and the international conventions and codes of the International Chambers of Commerce, ICC, right? Proper documentation in post shipment finance. So what are the things that needs special care? Documents should be drawn in permitted currencies. Okay, so you must check whether the currency which you are using in the document are permitted by the bank or not. Okay, then condition of receiving the payment must be as per the permitted method of payment. We have discussed different modes of payment in our last discussion. If you have not watched that video, I suggest you please watch that video. You will learn about the different methods of payment. If you have already watched that video, or if you are already aware of the topic, it's fine. That's very good. Then the next point is GR. What is this GR? GR is the guaranteed remittance. The full form of GR is guaranteed remittance. GR or PP form duly certified by the customs is submitted. Right? What is this PP form? PP form is used when the shipment is made by post office. Right? And particulars stated in the GR or PP form are consistent with the document standard as well as the sale contract or firm order or LC, etc. Right? So whatever particulars have been mentioned in the GR or PP form which you are going to submit to the bank, or which are duly certified by the customs. Okay, so it has to be duly certified by the customs, and when you are going to submit this GR or PP form to the bank, you must ensure that the particulars mentioned in these documents are in consonance with the sale contract or exactly as per the sale contract or firm order or letter of credit. Right? And we also need to be careful about the time limit. The documents are submitted within the time limit stipulated, and in case of delay, suitable explanation is made. So if there was any delay in submission of the document, you must have a valid reason and the banks must be convinced with your reason. Right? The period of usance is in consonance with the time limit prescribed for realization of export proceeds. Now we have few questions. I hope that will give you very good insight into this post-shipment finance. On what basis post-shipment finance is provided? Against the evidence of shipment of goods or supplies, right? Because that is the basis of issuing this post-shipment or crediting or financing this post-shipment finance to the seller. Okay, how much can be financed? What could be the quantum of post-shipment finance? Up to 100% of the invoice value of goods. Okay, here one thing I would like to explain. I'm not sure whether we have discussed this thing, but let me hope that most of you must be aware of what is deemed export. Okay, because post-shipment finance is also available for the deemed export, and I'm trying to explain in a very simple language, in a layman language. Deemed exports refer to those transactions in which the goods supplied do not leave the country. So how is it possible to export without the goods supplied leaving the country? Okay, I'm giving few examples, and if you need further details, I recommend you to visit the website of DGFT, where you will find the different conditions under which supply of goods are considered as deemed export. Okay, just imagine one situation where a seller is supplying inputs to the projects funded by UN agencies. So in that case, it is a deemed export. Another case is supply of capital goods to holders of EPCG license or EPCG scheme. Okay, there are many more conditions. Supply of goods to EOU units or units located in EPZ or ACZ or software technology parks, STPs or ESTPs, electronic hardware technology parks. So supply of goods to all these to all the units located in this kind of area or this kind of zone are considered as deemed exports, right? Now the next is, what is the period of finance? It can be short term or it could be long term, depend on the payment terms agreed upon by the exporter and the importer. But in case of cash exports, the maximum period is 6 months from the date of shipment, and concessional rate of interest is available for a period of 180 days to the maximum extent, opening from the date of surrender of documents. So this 180 days counting starts from the date of surrender of documents, right? One important point, the documents should be submitted within 21 days from the date of shipment. Okay, this is very crucial point. Now the next point is, what are the different types of post-shipment finance? So we will have a quick look at this list of different types of post-shipment finance. Negotiation of export documents under letter of credit, that is LC. Purchase or discount of foreign bills. Advance against bills sent on collection. Advance against goods sent on consignment. And advance against export incentives. Advance against undrawn balances. Advance against retention money. And post-shipment credit in foreign currency. So these are how many? 1, 2, 3, 4, 5, 6, 7, 8. 8 different kinds of post-shipment finance, right? The first one is the negotiation of export documents under LC. So where the exports are under LC arrangements, the banks will negotiate the export bills provided it is drawn in conformity with the LC, all the terms and conditions mentioned on the LC, right? So the bank negotiate export bills under LC. When documents are presented to the bank for negotiation under LC, they should be scrutinized carefully, properly, taking into account all the terms and conditions of the credit. Fine. And all the documents should be strictly in accordance with the LC terms. Let me tell you that the LC issuing bank undertakes to honor its commitment only if the beneficiary submits the stipulated documents, and even the slightest deviation from those specified in the LC can give an excuse to the issuing bank of refusing the reimbursement of the payment. And there is also a possibility, before the LC issuing bank refuses to reimburse the payment, this payment might have already been made by the negotiating bank, right? So these 3 points are important for negotiation of export documents under LC. Now the second type is purchase or discount of foreign bills. In fact, I thought of continuing, but let me complete at least this point. Okay. This facility is generally granted to exporters who enjoy bill purchase or discounting limits sanctioned by the bank. Okay. Then the financing bank is totally dependent upon the credit worthiness of the foreign bank, because here we are not doing this transaction against LC. Okay. Because the security offered by the issuing bank under letter of credit arrangement is not available, and that's the reason this credit worthiness of the foreign buyer is very, very important. And if it is a case of documents against payment arrangement, okay, that is DP arrangement, the documents are released through foreign correspondent only when payment is received, right? But what will happen in case of DA, that is documents against acceptance? Okay, we have already discussed this DP and DA in our last video. Probably if you want to know in detail, you can just have a look at those videos, or if you have already watched the video, if you are already aware of this system, nothing to worry. Okay. So in case of documents against acceptance bills, what happens? Documents are delivered to the overseas importers against acceptance of the draft to make payment on maturity, right? So the importer accept, puts his signature and sign and seal, and give a guarantee that okay, the payment will be made on maturity, right? Then ECGC policies are issued in favor of exporters to cover the risk. Why? Very simple, because the financing banks are open to the risk of non-payment under this policy. Okay, so what happens? ECGC fixes limits and payment terms for individual buyer, and the financing bank has to ensure that the limit is not exceeded so that the benefits of policy are available, right? And banks also secure a guarantee from ECGC on the post-shipment finance extended by them, either on a selective or whole turnover basis. Banks sometimes may obtain credit reports on foreign buyers also. Okay, because a good credit report of the foreign buyer minimizes the risk of non-payment. That is the only reason banks want to, sometimes, not always, but sometimes they may want to obtain credit reports on foreign buyers. Right. So thanks a lot for watching this video. We will continue the remaining types of post-shipment finance and some other related topics if necessary in the next discussion. Till then, goodbye.